G'day everyone, welcome to this month's Facebook Q&A. We're doing a lunchtime session today rather than after hours. Al's off on holiday. I'm Michael Beresford, Cam McClellan, one of the fellow directors here at OpenCorp. And we've got a ring in today.
Matt Minute, how are you?
There we go. Matt's had an association with OpenCorp for the last 6 or 7 years.
Yep.
He's got over 2,000 clients. He's a mortgage broker. He's helped countless OpenCorp investors and clients to be able to structure their portfolio the right way. He's an award-winning broker, several times in the top 100 brokers in Australia. The point is, we've got a finance guru with us today. There's a lot happening in the market with regards to interest rates, with regards to APRA, pre-election, post-election, what's going to happen with the cash rate. Finance is the topic of today, so we thought we'll bring in the expert and we'll go from there. So as always, guys, it's light, it's upbeat. We're here to help you. Ask us the questions that you've got. Keep them coming through, and while we're waiting for some of those questions to come through, Matt, we might just start, I guess. Election was what, 6 weeks ago now?
Yep.
What have you seen in the last 6 weeks, and how's that differed to pre-election?
What a turnaround. Like literally the week of that election finishing, we've seen a big uptick. We've had our biggest 2 months ever in broking. So we've, as a company, we've written over $60 million each month for those last two months.
Of lending,
Yep. A huge amount of inquiry levels have picked up. Consumer confidence seems to be much better out there as well.
Right.
So it's all ticking along, and as soon as we've got a bit more of a stable government, and everyone knows where it's sitting, it's just shot through the roof. So
yeah, I think the first thing, I was surprised out of the election that first weekend. I'm just spitballing here. I think the Melbourne market, there was only on the auction weekends about 400 odd auctions, so it was low, but we got around a 64% clearance rate. And I was curious to see how that pegged in the following week, which is about the same clearance rate, but about just under double the auctions. And that's just snowballed up, hasn't it? What was the last couple of weeks? We had Sydney itself.
Yeah. 74 and 75 in Melbourne the last 2 weekends.
Yeah, and Sydney's been crocking out some good numbers as well, so that confidence is definitely back to the market.
Yeah. Definitely a good uptick in the market, and even growth in Melbourne and Sydney markets overall. The CoreLogic data came out, said just this last month there's been a slight amount of growth in those two markets. So
it's really interesting, and I was explaining to a client late last week that really all a market boom is a groundswell of consumer confidence. That's all it is, right? People are X number of qualified buyers are sitting there in the back stalls, and then you start to see some activity, and then those people get a bit more confidence. So they come in, and then it just grows and grows and grows to the point where like Sydney a couple of years ago, affordability was too much of a stretch, and that's what signifies the top of the market. But really, it's just action around consumer confidence, and that's why it's
big uptick.
People hate change, right? So
absolutely.
Continuation of the coalition.
There was a lot of nervous people out there previous to the election, and since then it all seems to have changed around. So. Onwards and upwards. Hopefully we have a good solid months coming into spring. That's where I think we'll see quite an uptick overall.
And as have the majority, or how's that increased inquiry in the last 6 weeks that you talked about? How's that been split between owner occupiers and investors?
It's mainly investors.
Right.
The investors have come back on the market in a big way. Yep. I would say 85% of my inquiry were with investors. Now the rest of the team, acceptance, they all sort of have their own little niche areas. Some of them like to work on the owner occ space. Some want to do the SMSF, and but for myself personally, it's definitely been investors that have been kicking off. So.
And I should point out just while we brought Matt in. We talk about brokers constantly, about the different levels of brokers and what they specialise in. Now, OpenCorp's obviously got its own broking division, but we ensure that we have a number of partners, so we give clients the options to use multiple partners, so they're not forced to use OpenCorp services. And Matt's one of those brokers who we know, out of the thousands and thousands of brokers in the industry, there's only a very small amount that understand investment finance and how it should be structured.
Absolutely.
And you've just heard there, the majority of Matt's work is investment finance, so which come to the current lending regulations, the more we really want to get into that juice is what we drag Matt in.
Juice away, Cam.
Yeah, juice away. Juice away. All right, off the bat then, what do we got today's predictions for the rates? What's happening?
On hold.
On hold?
I'm in the hold basket as well.
Hold. You?
I'll go hold only because,
Peer group
and this is not peer group
He
pressure.
follows the pack.
He's pushed him into it.
I'm definitely a pack follower. Yeah. Is based on the banks. I think they're just they want to see how the banks and APRA's sort of current negotiations are going to peg out.
Yeah, absolutely.
Because that'll have more impact on the market than another drop.
Well, getting onto the APRA stuff, we've seen that they're actually looking at serviceability cap rates at the moment.
Yep.
So they haven't made an announcement, but it's meant to come through within the next 2 to 3 weeks. If they do an adjustment on that, where they allow the banks to reduce their servicing caps, currently they're sitting at about 7.5%, most of them. If they do it where they say like a 2% above actual rate, then that's going to make a big difference to the investors out there.
You know the dollar amounts? Just to put it in dollar perspective?
Yeah, I was going to say, I might just do a recap in case we've got some viewers that didn't see our last one or some of the videos that we've done since. So quick recap on and some context around what Matt talked about. Pretty much over the last 2 years, a bit over, regardless of the actual interest rate that you've been paying as a mortgage holder, when you've gone to either refinance or apply for a new loan, the bank is assessing you at 7.25 or 7.5%, right? So whether your interest rate is 3.6, 4% or 4.5, in the bank's eyes, everyone is being uniformly assessed at a much, much higher rate with a massive buffer built in. What APRA announced week after the election is that buffer, there's universal agreement that buffer is too excessive. So they've been working with the banks to reduce that and find a happy medium. And what Matt was talking about is one of those potential proposals is applying a standard buffer of say 2% on top of the actual interest rate that you're paying. So over the last couple of years since this 7.5, let's call it, serviceability floor has been in place, owner occupied interest rates have come down a lot more compared to investor interest rates. So there's no longer a kind of uniform interest rate in the market. There's a lot of variability. And APRA are basically saying, well, maybe we add 2% or 2.5%, whatever it might be, on top of what you're actually paying. So if we consider that 5 weeks ago, a mortgage holder might have been paying 4.25% on a mortgage, right? And if we were to add 2% on top of that, then straight away, they would be assessed at 6.25 with the banks, compared to 7.25 or 7.5 that they are now. So help me out here, Matt, but drop of 75 to 100 basis points would add about 100,000 to the borrowing capacity
roughly,
ballpark. Now, obviously, the more property and the more debt you've got, the more that buffer will influence and improve. But as a general rule, if you've got one loan, that's the kind of improvement that we'll see. So what's pleasing about this stuff is that they're, for the first time in a long time, they're tweaking the knobs, right?
About it,
They're not all or nothing and hitting the market with a sledgehammer. So that's, I guess, what we're seeing, and then we'll get onto interest rates shortly. But with the interest rate coming down, the cash rate coming down 0.25% a month ago, and some future projections. It's not really a case of will it happen this month or next month. It'll happen at some point, right? Then that will further bring the assessment rate down again, which will then bring some more buyers into the market. So for those that weren't aware, there's a kind of not so quick recap on the dynamics and the moving parts, I guess, on what we're seeing. But with regards to the RBA meeting today, 70% of the commentators out there,
the economists, they're
are
all
predicting
saying,
a cut, right?
Predicting a cut, but
if we were wrong, it wouldn't be too bad.
No, that's right, exactly. Even if they do, even if the RBA does bring in a cut, I wouldn't expect that all the banks will pass on the full amount. I think they're worried about their margins and their profitability. I wouldn't be surprised if the big four sort of only bring in a 0.15 or a 0.2 if it comes through. But as I said, I don't expect the cut to come through today. I think RBA will take a wait and see approach, see how what's already happened and whether any of these apronastic changes affect the economy further, and just try and get it at a level where it's stable, you know.
Yeah, the reason I'm in the whole camp is for a couple of reasons. So number one, even though the announcement happened a month ago at the last board meeting, most banks didn't actually implement the decrease until last week or only a week and a half ago.
So their fair time to do it.
Yeah, you, which is pretty standard behaviour. But the point is, you don't see. It's not like you're paying less on your mortgage and tomorrow instantly you're out spending more money or whatever else. Like there's a bit of a lead time for this stuff to take effect in the market. Yep. So that's why I think they'll hold. Plus, it obviously just gives them some more time to. Reducing the cash rate's a pretty major exercise, right? They don't want to do it if they don't have to. So see what the impact is and
see what the trends are, see how it affects everything out there. As you say, it doesn't happen overnight, so it can take a little while for these things to take effect. And so to do the analysis on it and see whether it's worked or whether they need to do further tweaking.
Coupled with that, August and September RBA meetings are really when big businesses will be reporting end of financial year results.
Yep.
So we'll start to get a bit of a litmus test on the business climate out there.
Sure.
Plus spring selling season, the cut could happen in either August or September, and still have a positive flow-on effect to the major selling cycle within the year. So,
absolutely.
Given I've said all that, they'll probably cut it today, and we'll all be wrong. But that's kind of the background.
But for investors, really what it means, if you're looking at you mentioned groundswell before. And I know we see it on the street at a daily basis, and you can feel the pickup straight away. For the average punter out there who's investing, or the mum and dads who are sitting at home, they don't notice that. Right, there's probably no difference to their day-to-day life until obviously the interest rates come back. But as far as investors go, we see that pickup go, and you don't get that growth, and the growth will start to come. And it's not only once you get a bit of growth. So we're looking at 6 months. The people who get in will get the start of that. Then you'll get a good 6 months of the newspaper articles coming out, and then the groundswell really builds, and then the majority of investors jump back into the market. The mum and dads, upgrade their homes, and then you just see that spike going.
Yeah.
So
it's funny. One of the key triggers that I notice, we'll feel it straight away, and then you'll just see all the articles on the news. They'll all start to be slightly positive. So things like auction clearance rates and uptick in actual housing prices and all that, and that's what we're seeing straight away.
We're very amused by that comment.
Bang,
I know.
You probably didn't see it, mate. The reason Cam and I are laughing is because on our one last month of these, on one of our WODs that we actually shot a couple of weeks ago, the same news outlet, right, had polar opposite headlines 3 days apart. Right.
Yeah.
Sydney, Melbourne house prices will continue to crash. Sydney market house price is going to rebound, and obviously markets don't change.
I think they're flipping a coin.
What's going to sell some papers today?
That's it.
But the other thing, just to what you were saying before about kind of a 6 month time frame, Cam, is yes, we straight away we start to see the articles and the media become more positive, but let's say that it takes a month for a house to be advertised and to go to auction, and then you have a 2 or 3 month settlement period. It's not until best case scenario 4 months from now that you actually get the data coming through, which is what gets reported on in terms of price growth. So there's always a lag between what we're reading data wise and what's actually happened. 4 months is a third of a year. It's a fair chunk of time. So always, I guess the number one rule. When you can get valuations that stack up, when you've got borrowing capacity, when you're able to move forward, do it.
Do it when you can.
Because it can change tomorrow.
That's the number one rule. And always when I'm working with investors, if they've got equity, I'll get them to pull it out for the future purpose. If that's what they're keen to do, that they're wanting to build a portfolio and all that, you do it when you can, rather than I'll do it when I've actually found a property or anything like that, because things change in the market, things change with banking regulations, credit tightens, and when you want to do it, you may not be able to pull it out. So you do it when you can, get yourself set up correctly first off, and then when you've got the opportunity, you jump on it. So
it's funny though, for the last 20 years of investing, and my investment mentor Steve, who has been investing over 20 years on top of that, there's one saying that we've always thrown back and forward is they never ring the bell when the market's at the bottom.
No.
When it's about to start climbing. But they're talking to Al during the week, who's one of our business partners, and Al's analogy was that it's probably the closest to a bell being rung that you're at the bottom of a market.
Absolutely.
It's the first time you can actually, usually there's a bit of cloud and mist around it and you're going, it's going to clear, you can actually see the top of Everest now.
Yep.
You know, and you're at base camp and you can see, off we go. So, and I think that's to do with the fact that it's only lending regs that are holding it up.
Oh, absolutely.
So finally they've gone, all right, game on again. And so that's as close as you can get with the recent announcement that the bell's been rung and away we go again.
Yeah, so you guys will know this, but for some of our viewers out there, one of the my favourite analogies is, with the benefit of hindsight, would you have loved to have bought a property wherever you live 30 years ago? I'm yet to meet someone that says no, right? I'm yet to meet someone that says no. But if you think about what's happened in that time frame, and we've actually just done a major piece for your investment property magazine that'll be coming out in the next couple of weeks around exactly this, is that in that time frame, give or take, negative gearing was removed. It came back in. We had the recession that we had to have. We had an Asian financial crisis where some of our more mature viewers will probably remember it. Some of the younger viewers probably not so much. But international stock markets lost 60% of their value with that. Right, and that was supposed to crash the market for 10 years. Only 3 years after that, we had September 11. And then 7 years after that, we had the GFC. So the point is, all of those in their own right, let alone collectively, are major global events that could have, if they were going to crash a market, they probably would have. We haven't got any of that at the moment, right? So what we do have though is a really tough lending environment, and that's just reduced the number of qualified buyers.
And look, we still do have that tough lending environment, but I think a lot of the changes came in, changes around things like living expenses. We've still got changes coming through in regards to substantial benefits. So if a husband and wife buy a property and she's got less than a 20% stake in it, well then there's going to be more requirements around certifying that she's happy to move forward, legal requirements and things like that. So there is still tougher requirements out there, but we're managing to move through them a bit better. There's not so much grey around it anymore. And things with the servicing, that was really brought back very hard over the last sort of 6-12 months, and all of that's starting to ease up. Lower interest rates, the gaps between owner-occ rates and investment interest only are not as big as what they were. They really broadened out for a bit. They're starting to pull back now. The banks are wanting to gain more margin, so all of a sudden you're seeing more specials out there, interest-only specials, investment specials, all that.
That's actually it. Sorry, mate.
Yeah, no, just for viewers, you mentioned before, and I know the answer, but I thought I'd just clarify it. Why would someone go, the one investment property with a couple, go 80-20 split on ownership?
Me?
Well, we can rock scissors paper, mate. You're the guest, you take it.
So in regards to taxation benefits, basically. So it depends on who's the bigger earner as to how much percentage you want to have, how much taxation benefits you want to gain out of having that property. So obviously you talk with the people in the know, you surround yourself with quality professionals, OpenCorp, good accountants, good brokers, get the right advice, get yourself structured correctly, and you build a good you build a good portfolio.
No, good, very good.
Yeah, cool. Something you said before was just a really good lead into to one of the questions that we've had. What would be a good interest rate for an investor loan at the moment?
Okay, anything under 4.5% is a great rate as investment interest only. Now we're getting them as cheap as 3.91, but you have to qualify with that lender for that specific rate. So if your rate's under, 4.7, 4.5, under that, you're doing okay. It's cheap lending. At the end of the day, those rates, they're cheap lending. Yeah. People get caught up with about, I'm missing a 0.25. And you got to look at the overall scenario. Does it allow you to build a portfolio? Does that lend actually allow you to do what you want to do? So you may not always get the best rate, but it's about achieving your net goals at the end of it.
I think our rates are about number 4 on the list when you're
Absolutely.
getting structure. Yeah.
Has that one come out yet?
I don't think so, actually.
Yeah, right.
We recorded a short video the other day, Michael and I, basically outlining the importance of different factors. So stay tuned to the website. I think it'll get rolled out pretty soon.
And if you're keen to kind of understand what Matt was talking about, structures to build an investment portfolio, jump onto YouTube, check out the OpenCorp channel, Finance 101.
There you go.
Is what it's called, I think, or avoiding cross collateralization. We draw it out for you and explain that. So, all good, because really, when you think about with an investment property, right, 0.5% might make a big difference on your own mortgage if you're shelling out 100% out of pocket. If you've got rent coming in and you've got tax deductibility and all those kind of things, really the difference between 0.25 is minimal.
Yeah, but if it allows you the higher rate, but allows you to duplicate because your structure's right,
you're a long way in front.
Correct.
Yeah. All good. So there's a question here from Kate. G'day, Kate. Thanks for joining us. What are the living expense limitations that you're referring to? So
living expense, we used to be where you could just nominate a living expense, say, $1,000, $2,000 per couple. And that would be fine. Then they moved into a HEM expense where that would be the absolute minimum that you could put into the lending, into an application. Now, every bank wants to see a breakdown of your full living expenses. That's everything from your transport to your rates, your utilities, your recreational expenses. Now, if it doesn't fit in amongst your circumstances, if you're a couple on a couple of $100,000 and you're saying your living expenses are only sort of $2,500, $3,000 a month, they'll want to look at it much more heavily. And so then they'll ask for all your 3 months worth of transaction statements, your credit card statements, and they want to do a verification on it. Yeah. Now this was all brought in through the Royal Commission. They said that the banks have to do much more scrutiny on living expenses. So living expense is one of those big things that can get you caught up and have an application fail because of what's been shown on there. Even if it's something like going to the horse races all the time, or putting on bets, and if you
income all from betting. Yeah.
That's right.
It's consistent income from betting.
So living expenses is one of those real things you've got to be careful of. It's got to be relatively correct, but there are ways that you can get yourself into a better position. Obviously, if you're going to do a loan and you've got a bit of time, you can speak with a broker or with the guys at OpenCorp because they're fairly across it as well. In regards to how you can limit things and how you can get caught, basically.
What are the best ways to improve your borrowing capacity? What are the things that someone could do between now and Monday morning to improve their borrowing capacity?
So credit card, personal loans, limits.
Sam's favourite.
Yeah, absolutely. I mean,
cancel them, not cut them up.
Absolutely, just get rid of them. I mean, if you have a credit card, just have a very low limit. Most people don't need more than a $5,000 limit between you. So that's one thing. Things like if you've got a HEX debt and it's only a minimum amount and you've got lots of equity or you've got the ability to pay it out, pay that out. Same with personal loans or leases. They're all things that will reduce your servicing capacity quite a large amount.
Yeah. Mm-hmm.
So yeah.
And you can't manipulate those expense figures, but for the 3 months prior, don't go like a lunatic and have the time of your life. Is that what you're saying? So,
absolutely.
Keep your expenses to a realistically minimal amount.
Yep. Because we all know, look, a lot of expenses are discretionary. Unfortunately, the banks won't see it that way. Mm-hmm. So even like private school fees, they're discretionary, really. If you've got the income to support someone to go to a private school, well, you're not going to lose a house because you can no longer afford to pay for your kids in private school. You're going to pull them out of private school and put it into public. So that really is a discretionary. But those figures have to be put into an application and have to be shown.
So speaking of kids, and not that I'm against population growth and families, far from it. Hang on, I've hit something here. How do I mute this? There we go. Sorry guys. What was I saying? Yeah, kids. So one of the most common things that we see or hear are people saying things like, "Oh, we're pregnant," or we're thinking about having a family, right? We'll wait till we've had the baby, and that impacts them on a couple of fronts, doesn't
Absolutely.
it? Because you're going to be down to a single income earner for a period of time, and you're going to have all of the living expenses that banks associate with dependents thrown into the mix. So, case in point, if you are thinking about that stuff, do it first, and have a buffer for your cash flow so that you're not caught short.
Yeah, absolutely.
Get your investment portfolio sorted out first. Yeah, stick with a dog until you get an investment portfolio.
Small dog.
Yeah,
so it doesn't need much.
That's right.
All good. So we've got a question here from Adam. G'day, Adam. Good to see you not on the golf course, mate. Or maybe he's watching this while he's in the clubhouse.
Probably is, yeah.
Probably went 4 under this morning. Adam's question is around what's the typical time that we would expect between when a client buys their first property, and Adam and his wife, congratulations, settled on their land last week or thereabouts.
Awesome.
Congrats. That's
after about 3 years of planning and prepping and all that kind of stuff. So that was awesome. What's the time frame that people can expect between the first investment property and the second investment property?
So many factors. Unfortunately, so many factors.
So what are the key things? What are those key factors, and what are the things that people can be doing?
Yeah, how do we get a yes if we're trying to build a portfolio?
Yeah. Okay. So one of the biggest key things is the amount of income that you have. So if your income is not sufficient for the second property, or it might take you a while before you either get your bonuses or your wages increased or whatever, so that you're actually qualified for that next property. Second one would be capital growth in your existing property. If you've already at a high LVR on the first one, well, you need to wait until you've got a bit of growth in that you're able to pull out equity to then purchase again. Back a few years ago when Melbourne specifically was booming, people were able to pull out enough equity within 6 months. Every 6 months they're pulling out equity to buy another property. We did a lot of double ups, triple ups, and over that period. But then, of course, every housing cycle you're going to have your slow periods, and we do get some clients who are a bit frustrated at the moment because their growth isn't as fast right now. But that's just a period that you go through, and you know that you just got to be ready for when the period really starts to pick up. That you're good to go again.
So two key parts come out of that. The first is that people get busy. Right, life gets busy, and you think, oh yeah, the good times will be around forever, and you miss the opportunity, and then you're stuck. Right. So Adam's second question is who keeps an eye on when we're ready to do another investment, I guess how do we help with that? So we're constantly feeding as your ongoing mentor. Remember we talked about those portfolio reviews and that strategic portfolio management that we offer. Yes, OpenCorp help with that. And every 6 months we're drip feeding information on comparable sales and market rents, reviewing your borrowing capacity, basically keeping your finger on the pulse a couple of times every year. A great case of that was, we'll keep the first names for privacy, Jose and his wife, right? I
know where you're going with this.
Right. If they didn't have available equity, they wouldn't have been able to purchase the property that they have just moved forward on in the last 48 hours. Okay.
Absolutely.
Our recommendation was, and they live in Sydney, so while the equity is there based on a really good valuation, let's pull that equity out. It can sit there until you're ready to use it.
No cost to you.
Doesn't cost you anything because you're not paying interest on it. But because we did that, they've been able to move forward.
Straight away.
So Cam talks a lot about coaching and mentoring, and that's a big thing that the theme of the WODs lately. That's I guess where we talk about using brokers, we talk about the kind of expertise that coaches and mentors provide. That kind of stuff is invaluable around people being able to move forward and grow a portfolio.
Absolutely, and with a good broker, they will also send you information regularly. So you'll get your normally monthly updates about what's happening on the market. You'll get any special updates that are going on. You should have a 6 monthly either call or email asking, do you want a review? And you should take them up. When you get a chance, get yourself reviewed every sort of 6 months or so. You may not be able to go now, but any information that is pertinent to getting you to move forward for the next one, a good broker will be able to tell you right there and then. and they'll say, okay, well, we should really clear out this credit card or whatever it is to get you into a position to get your next one.
So based on Adam's question, going back to that, he should sit down with you, Boz, tick off the first things. Can you get a pay rise? Have I get rid of HECS debts, credit cards, go through those key things, what's your expenses over this period of time, and then leave it to you to monitor the market and tell him when it's time to go again.
Exactly right.
Yeah.
Adam's actually self-employed.
Yep.
So another, just like the kids, right, the planning is the really important part. And what we see is a lot of self-employed people will come to us and say, oh, I've just had my financials done, this is my situation. Because their accountant, acting in their best interest of reducing tax, has brought their financials down to here, right? They haven't got borrowing capacity. If we'd had that conversation a month before they lodge their tax return and we say, right, this is the least amount of income that you need to disclose and pay tax on that allows you to get borrowing capacity, then you're just 12 months ahead of where you would otherwise be.
Or even getting them to do draft financials first. So not lodge, just draft financials. They send them through to us, we can do an analysis and then go back to the accountant and say, well, for them to move forward, this is where they really need to be. You're showing us this, you're writing off everything under the sun to get them up to the next stage. Let's see if we can manipulate it a bit with your accountancy expertise.
Legally.
Yeah. And often we find that's the case, that they're able to do that, so,
Cool. So what are the, that's maybe a good segue, what are the, for the self-employed viewers out there, what are the kind of things that can improve a borrowing capacity, like add backs and those kind of things that can help people that aren't necessarily up to speed on this stuff? What can they be thinking about?
So one-off expenses for your business. If they're major one-off expenses, if we can have them specified out there, we can add that back as income. Depreciation, we can add that back as income. Depending on how you have your profitability in the actual financials, whether it's company retained profits. A lot of lenders won't allow that as income, so sometimes it has to be dispersed out. There are some lenders that will do, Macquarie, but yeah, so it just depends on how it's actually set out there. But that's why you should get your draft financials, get it to a broker, they can analyse it and let you know, where you're sitting.
Good. G'day George, g'day Michael. Thanks for jumping on. Hope you're enjoying it. Daryl, g'day Daryl. Hi guys. At what point do you look at moving your investment properties into a trust?
It's a really good question. I don't move them into a trust because you're going to pay
stamp duty. You're going to become a referee here in a second, mate.
Ding ding ding.
No, it's all good.
Obviously, and there's a section in my foyer of the property investor. There's a section on trusts, understanding them in a really simple format. Trusts are really good. People who build a portfolio, and Michael probably slapped me around here, but people who generally, just general advice, build a portfolio, might buy the first few in their own personal name. Take advantage of the negative gearing. And when the portfolio and their income starts to come back from that portfolio, they may set up a trust to protect future investments and make it easier to hand it across to their family down the track, or change the beneficiaries so your family becomes in control of that trust.
That's the standard way. That's how we fairly see most people when they're building.
So this is a classic case of everyone's individual situation is different. Okay. And really it comes down to a trade-off between asset protection and structure. Your likelihood of basically being sued. So if Matt, if you weren't a finance broker but a brain surgeon, we wouldn't be going further until you had a trust set up, right? Because that risk is relatively high. The trade-off is on the cash flow, because if you're a PAYG employee, Daryl, I'm not sure what your structure is, but if you're a PAYG employee, group certificates and payslips, and you buy in a trust with no other sources of income, then you can't actually claim the tax benefits, let's call it 10,000 as a round number. You can't get that $10,000 per year in tax benefit fed to you year on year. They basically go as offset against future income. Right. So if you think about what $10,000, let's call that $200 a week, based on where interest rates are at the moment, that's basically 4 properties that the typical Australian could hold in their personal name for $200 a week out of their pocket compared to one property in a trust. And when you look at the compound growth in both of those scenarios side by side, hence why it makes a lot of sense for most people to acquire the first few in their personal name, acquire those tax benefits year on year, keep the low cost to hold, get the compound growth, and from there you have a lot more flexibility around how you structure things, and hence why trusts can make sense after that.
Probably a good WOD topic one night, isn't it?
Yeah.
Get them.
I think there might actually be probably an old one with some bad haircuts.
Probably time
update.
The other possibility to build trust straight away is not just protection, but if you've got a ridiculously high income and you're really not reliant on that negative gearing to build your portfolio.
Yeah. Keep the questions coming, guys. So this is really good. G'day, Miles. Thanks for jumping on. How far out should business owners work with their portfolio manager / broker before they meet with their accountant for end of financial year, tax planning time, or ASAP? Great question. We probably covered, but yeah.
Brokers generally would be around that tax planning time. So around the May to June, you'd be speaking with your broker, because that's when you're going to be getting your draft financials sorted out and all that sort of thing. So you'd be just going over getting the broker to do an analysis on where you're currently at, and based on your last financials, then saying to them, go and see your accountant, get some draft financials, get them back over to us so we can see what the difference is, and then make some adjustments from there if need be.
So I think I've got mates who are tradies who have gone through this, and you've helped Ben and Anna in the past. So who I'm thinking of is it's better as soon as possible is better, because if you're not in a position to invest straight away, it may take you 12 months of curbing your spending and changing the way you operate your business to make a huge impact. It might take you 12 months, but it's better off to plan it out and get there rather than get there and go, shit, I can't do it again.
Sorry, I was actually talking about someone who'd already seen you with previous tax financials.
No, that makes sense.
If you haven't, straight away, absolutely.
Cool. All good. I can never say this.
Regulatory.
Thank you. Question from Adrian. It's like cross-collateralisation. I can say it, no one else can, but I can't get the simple ones out. When defined, will the new Code of Banking Practice have an effect in the mortgage broking industry?
It's starting to push through now. They're starting to do bits and pieces of it. Part of it is the financial abuse stuff.
Right.
So a lot of the banks are pushing out little statements saying that is the broker aware of any financial abuse? Now, financial abuse is where there's been coercion for getting a loan. So let's say a husband and wife, the wife didn't want to, the husband's twisting the arm. If we are aware of any type of situation like that, it could be where you've got two people on an application, but you never speak to the second person. You've got to be able to tick off that, yes, they're all fully aware and all that type of stuff. So some of that's coming through now, and some of it's going to be pushed through over the next few months. But there'll be quite a few changes in that area, I think. A lot of it sort of legal, so on applications and on contracts, and some of it where we've got to be careful about what we're ticking off, because how do we know if there's been financial abuse? But we're ticking it off, and we might have only had a 2-hour conversation, but that doesn't mean that you know the person's situation very well. PI insurance is saying that we may not be covered if we tick that off. So there's quite a lot of argy-bargy in the industry about this at the moment. But yeah, so it's starting to come through. We expect quite a few changes over the next sort of 2, 3, 4 weeks. And yeah, just watch this space more. As soon as the information comes out, we'll be pushing it out as well. And I'm sure you guys will.
So takeaway point. I get this comment a lot. Finance is hard, guys. Strap yourself in. It's going to be 4 to 6 weeks of pain, right? Short-term pain. Use a broker. Use someone that understands investment structures. They can do all the legwork. You just have to provide the information. But you know, it's not as simple as it was 10 years ago. Be prepared to spend that time and effort up front. Adam, who we were talking about before, his was a fair bit of effort. He said it on his land last week, and he's forgotten about how hard finance was, right? So it's a very short window. 10 years on, you forget about the pain, but you you look at the results of the properties worth having. So
one of my good mates was in my wedding party. This is obviously a long time ago now. But I remember Michael organised a property for him, and his pay slips got lost by the bank, and he had to go back and request them again. And these are like just little things. They're annoying. And I remember him whinging to me. And at the end of it, I think he'd made about $90,000. So that was a lot of money back then, because that was 10 years ago plus. So I said to him, hey, was the couple of hours of searching around for your pay slips worth the 90 grand? So it's worth the effort, guys.
I always say to my clients, expect to have to provide a ton of paperwork, okay? So that's one thing. If you're looking at building a portfolio, get your files and your paperwork in order. Make sure you keep your rates notices, your pay slips, your group certificates, Make sure you've got access to your loan statements, so you've got onto the internet and can actually pull them off if you need to, so that you know how to do all this stuff, rather than at the last minute going, oh, I don't even know what my login number is, Get that stuff, because that's one of the biggest things that slows up finance overall, is lack of documentation.
Like years ago, we used to provide concertina files to clients, and I think we still do, but we also provide a recommended file structure within hard drives now to keep everything in order.
Yeah, no, it's the way to go for sure.
Right about now, I want to give a big shout out to Cam's mate from high school in Bairnsdale, Joel. Yeah, getting paperwork organised was the smallest of challenges for those guys, wasn't it? We got there in the end. Happy days. G'day Joel, g'day Trish.
Yeah.
I've got a ripping question here from Daniel, and this is around another case of being ahead of the curve and pre-planning. This is great. If you've taken out an equity loan against your primary place of residence, and then you want to sell that primary place of residence, does the equity loan need to be paid off with the money from the sale, or can you keep that and pay it off whilst looking for another primary place of residence?
The only way you can keep it is if you're doing a portability loan.
In English, what does that mean?
So if you're porting the existing loans that you've got over to the new purchase that you're going to do, okay? Generally, those loans, it doesn't matter if those loans decrease slightly, they cannot increase. It can't be a change to the credit contract at all. So if you're able to do that and we can port that structure directly across, then no dramas.
So basically what...
No, that's right, and I'd assume you'd be able to do a nice little diagram so people can understand it when you're spelling it out to them.
Yeah.
So basically what we're saying is if there's a house in Blackburn, and then people are selling in Blackburn and moving to Montrose, right, the equity loan that's taken out against Blackburn, when you sell that property, you'll need to pay out the mortgage, but you can then effectively transfer or port that equity loan to be then secured by the new property in Montrose, right?
You can transfer both if you want to, if there's enough available equity in that other property as well. You just can't increase the lending, that's all.
So the key part, if you're thinking about moving house and you've got equity loans in place, talk to your broker before you sell and before you move, so that this can be planned out, because it's quite a relatively straightforward process when it's done ahead of time.
But there are only some banks that will do it too. So some lenders won't do it. So if you're with a lender that won't do it, but you really want to keep it, well then it's a question of refinancing to a lender that does have portability loans, then moving forward with the sale and porting it after.
And if you don't get a similar answer to that when you ask your broker, find a new broker.
Yeah.
It's a bit of effort.
It is a bit of effort.
Brokers
Absolutely.
won't. The lazy ones won't necessarily be willing to spend that time and effort just to help you out. But it's a key point, because once it's done, it's too late, right? Unless that whole portability system is set up ahead of time, banks will just pay out the equity loan with the sale proceeds.
Absolutely. And then you've lost all that
tax deductibility.
Good question.
That's a great question. How are we going with questions, guys? Keep them coming if you've got them. Just while we're waiting, anything I guess to add around what the outlook looks like from a lending perspective over the next 6 to 12 months, Matt?
I think what we'll find is that there's going to be more specials out there. The banks are clamouring for business at the moment. We're seeing fixed rates really low. Don't fix your loans at the moment, guys. No point.
That's general advice, not specific advice.
but don't. No, seeing very, very cheap fixed rates out there, but variable rates are looking to come down, and we should have at least another rate reduction soon. The banks are clamouring for business, so they're bringing out specials. All the big banks are giving cashback offers and things like that. Investment interest only rates are coming down. It's been a long time since we've seen them under 4%, and now there are a couple of lenders that they're under 4% if you fit their criteria. So yeah, lending's going to be better, I believe, overall for investors.
And lending for us as investors, and for the investors out there, easier lending makes prices go up. And for investors, that's a good thing.
It's just supply and demand.
Yep.
More people with borrowing capacity brings more people into the market.
Correct.
A bit more stability too. Since the Royal Commission, where the banks were changing their policy day in, day out, we're getting, every week, we're getting a bank changing how they did things, and caps and living expenses and you name it, any number of different changes. It is all now settled down much more. So we've got our handle on it much better than what we had, say, 6 months ago, when the changes were just happening that fast that you just couldn't keep track. So with that, with the rate drops, with the potential servicing cap drops, yeah, I believe it's going to be, the next 6 months I expect to be pretty good ones.
Is your watch not working, mate?
Yeah, thanks for that. The battery's dead, guys.
So it's just for show.
It is.
I was just looking at the time, and it was saying it's 12 o'clock still.
I bought it at the tinker shop down there.
There you go.
I had something to ask you. What were we talking about just before then?
What were we talking about?
Oh, the landscape.
Landscape.
Yeah. So I guess you mentioned about fixed and variable, and you mentioned about cashbacks, and specifically around the cashback side of things. Yes or no? Do you get a better deal as a new customer than you do as an existing customer?
Absolutely. Every bank treats new customers as gold.
Right.
With their existing customers, not so much. So I generally think that most people will only stay with their existing lenders for 2 to 3 years max, because as those years go on, the banks creep up the rates. And then when you're hassling them for a better rate, and especially if credit's tight, they won't give it to you. Now, at the moment, you can actually speak to your lenders and try and get better rates, and a lot of them are offering them because they're clamouring for business, but that's not always the case. But a new to bank client, they'll be given better rates and better deals overall.
So be a bit selfish.
Absolutely.
We talk a lot about the fact that banking loyalty went out in the 60s when the
there
bank manager actually
loyalty.
Personally signed off on your loan application. That doesn't happen at the moment. So key action, 2 actions, guys, for anyone with a mortgage out there. Number 1, first point, understand your borrowing capacity right now in terms of what's possible, because you might be able to refinance and get a better deal. You might be able to pull out equity, you might be able to be well positioned for an investment property if you can't do it currently at the moment.
If you don't have a good broker, shoot through an email and we can put you in touch with Matt or someone else on our team.
Yep.
I'll give it to you, mate. So.
Thanks,
No, that's all right.
I'll slip you that 50.
You should, full disclosure though,
We do.
There is no referral fees between our businesses.
Correct.
Absolutely.
And secondly, make sure that you're consistently reviewing your loan options. No longer set and forget. And I bank with Commonwealth forever, so I'll leave it there. Take advantage of those review periods, just like we talk about with your portfolio. Do the same from a lending perspective.
It's amazing, because I'm still seeing clients now with an owner-occupied loan and they're over 5%. And
Really?
that is just ridiculous in this day and age, when we're getting rates as low as 3.4, as a P&I repayment.
I had a more expressive analogy, but I won't go. But they're getting bashed around.
Yeah, no, the banks have no allegiances to you. They might, feel like they do with their nice juicy ads, but definitely get yourself reviewed. Always look after yourselves. Get your best rates, and get structured correctly.
Cool. Another one from Adrian. Thanks for the input, Adrian. Will the banks increase the household expenditure measure? So we might just need an explanation on what HEM is, if they reduce the assessment rate.
I don't think it's going to have anything to do with the assessment rate overall. It's going to do with keeping the HEM levels at a high enough area. That's the one area that the Royal Commission was really strict on, was the living expense area.
So what is the HEM?
Right, so it's based on your individual incomes as to how much they believe you should be spending as a living expense. So people on 50 grand each will be spending having a living expense a lot lower than, say, people on $100,000 each. And so that HEM index will go up depending on where you live as well, postcode driven, as well as income amounts, as well as how many kids you got and all that sort of thing.
So basically HEM is an arbitrary amount assigned by the bank to your living expenses based on an assumption on what you earn, how many kids you got, where you live, a whole bunch of variables, right?
Yep. Yeah.
So whether your living expenses are less than that HEM,
doesn't matter if
they will still take the higher amount, right?
Yep. Now, if you're in the country, or not even in the country, but you grow all your own vegetables and all that sort of stuff, and you don't go out to the cafes or anything like that, well, it's not going to matter. They're still going to have that index amount, and you've got to service your loan and that indexed amount as well, even if you're only on half that. So.
Yep.
To answer Adrian's question, you don't think there's going to be
it won't change with the assessment rates, no.
Yeah.
If anything, it'll go up higher.
So the scrutiny on living expenses is here to stay.
The number one thing out there, I believe. Yep.
Cool. Well, I think that's it for questions. Is there anything that we haven't talked about, Matt, that you think is important for people out there to know to wrap up?
No, just we have talked about it, and I think it's just the number one key thing, and that's just get reviewed regularly. You know, talk to your broker, talk to your investment gurus here, and make sure you know where the market's at. Make sure you know where you're at. Make sure you know where you should be going. And that's pretty much it.
I think just to add on, I appreciate your time today, mate. The difference with our lending regulations is what kept us safe and secure while the US fell in a hole. So while we talk openly, and the majority of the theme we're talking is we want easier lending regulations because property prices will go up, and that's I do want that. But the reality is we're kept safe by these strict financial regulations that are imposed upon our banks.
Absolutely.
And so it's a good thing. It's a tough thing, but it's a good thing.
You just got to know how to work your way through it. So. Yep, that's it.
Happy days.
Beautiful. Thanks for having me, boys.
Thanks for joining us, Matt. Really appreciate Matt's time. Matt's from Acceptance Finance. We've been working with them. They know their stuff around investments. So connect with him on LinkedIn, and I'm sure he can help with any questions. And we will see you next month. Thanks for joining us.
Cheers, guys.
Bye for now.